Day 4. Craft an exit strategy. The process of transforming an existing business into an asset of value include 4 steps. Complete a valuation of the business in its present form. Identify value detractors, the factors that detract value from the business. Develop a vision of what the business must look like in 3 to 5 years, and craft an exit strategy aimed at realizing value for the current owner of the business. On day 1, we evaluated the current state of the business and calculated 3 values for the business, namely the value that the business represents for the current owner, a fire sale value or low value as though the business is liquidated, and a profitability multiplier value or high value based on the business's adjusted earnings. This enabled us to come up with a value range for the business. We also identified the value detractors, factors that erode the value of the business. On day 2, we started by setting a target value or price at which the owner aspires to sell the business within 3 to 5 years. We then calculated the business's prime number based on the current financial results. The prime number enabled us to set an earnings and sales target for the business. We then envisioned what the business needs to look like in terms of people, processes, and policies in 3 to 5 years for it to achieve the earnings and sales targets. On day 3, we formulated the business's value proposition, derived from a strategy to create value for customers, suppliers, and ultimately shareholders. Now, on day 4, we must craft an exit strategy. The worst possible thing to do is to wait until you one day want to sell your business. You must start promoting your business to people within and without your industry as soon as you make the decision that the business is to become an asset of value that you can one day sell to prospective investors. Putting an investor pitch together is easy. Assembling all the documentation to present to investors requires little time and effort. But building a reputation as a competent and trustworthy business owner takes decades. Crafting an exit strategy starts by deciding on the type of buyer or investor that you will aim to sell your business to. What type of buyer will be willing and able to buy your business for the type of money that you require? Next, you must decide on the mechanics of selling your business. There are many more options than simply selling the business in a single transaction. How will you ensure that you get maximum value for your business? Then you must consider the timing of your sale. When is the right time to sell the business? Lastly, you must embark on a campaign to promote your business to prospective investors. Start by identifying the type of buyer or investor that you aim to sell your business to. Much is going to depend on the value and the nature of your business. There is no point in promoting your business to unsuitable buyers. As discussed before in this series, owner-operated types are unlikely to have sufficient capital to buy a business for a reasonable amount. So, for the remainder of this video, I ignore this option. An individual investor, sometimes called an angel investor, may be an alternative. According to the Southern African Venture Capital and Private Equity Association, investment by individual investors accounted for less than 4% of total capital invested in private businesses. Furthermore, the average transaction value amounted to approximately 5 million rand. You may consider selling the business to your management team. They have a vested interest in the success of the business, and if you train them well, will have the skills to manage the enterprise after your exit. But employees seldom have capital. A management buyout is usually financed by way of a loan to the employees. But this assumes that they will be able to secure funding. Alternatively, you may offer employees a loan at a fixed or variable rate of finance over a predetermined loan term. But that means you will continue to share in the risk of the business failing. Only now the business is no longer under your control, but in the hands of your former employees. Furthermore, you will not receive a lump sum, but will receive monthly repayments from the employees. Another option may be a combination of a management buyout with external investor, where you build a management team over a few years. You attract and retain talented individuals by offering them an ownership stake in the business. Once the team is established and has a track record of achieving good financial results, you present the business as an attractive investment opportunity to external investors. The benefit of this exit strategy is that you secure a lump sum from an external investor together with monthly repayments from your former employees. You may also retain a minority stake in the business and in doing so retain some control over the business. In fact, retaining a minority stake in the business may be a good strategy to attract an external investor. The investor may be more comfortable with a business where the founder continues their involvement for a certain period as caretaker of the business. Although this option requires more time and effort, I am convinced that owners can secure more for their business with this type of strategy. You may also consider the possibility of a strategic sale, where you sell your business to a supplier, customer, or competitor. Another business may consider acquiring your business for strategic reasons. A supplier may be persuaded that your business is an important distributor that gives them access to a lucrative market for their products. A customer may decide to acquire your business as an alternative to finding another service provider after your exit. A competitor may acquire your business to quickly build their team and production capacity. Venture capitalists invest in a business where capital may be deployed to scale the business quickly over the medium term. These guys are interested in a business where an accelerated growth strategy may be applied to grow the value of the business quickly. But most small businesses adopt an organic, slow and steady growth strategy, making them unsuitable for venture capitalists. Private equity investors are institutional investors looking for investment opportunities in established businesses. They typically want to acquire a minority stake in a larger business, 100 million rand business. Very few small businesses are suitable for private equity investors. Once you have decided on the type of buyer, you must develop a game plan. How will you dispose of your business interest so that you can maximize value for you, the founder of the business? Every situation differs. But here is a scenario that you may consider. Dispose of your business in 3 stages. Stage 1. During this stage, you embark on a program over a period of 3 years to transform your business into an asset of value, at the end of which you dispose of a minority stake in the business, let's say 30%, to your management team consisting of an operations director, sales director, and financial director. Stage 2. In 5 years, you sell a majority stake, let's say 50%, to an investor. When you have a business with an established management team, a track record of generating growing earnings, a diversified customer base, little or no company debt, and a full set of credible financial statements supported by established business systems. Stage 3. In 7 years, you dispose of the remainder of your business interest to either the management team or external investor, or a combination of these. The benefits of this strategy include: you have an opportunity to transfer knowledge, skills, and relationships to the business. You address the second value detractor, namely transferability. This strategy also enables you to attract, train, and retain a management team. You address the first value detractor, namely independence. You have time to increase sales and diversify your customer base. You address the third value detractor, namely customer concentration. You can manage and reduce company debt so that you can present a business with no or little debt to investors. You address the fourth value detractor, namely indebtedness. You can develop processes, systems, and implement financial reporting, thereby addressing the last value detractor, namely muddled up records. By retaining a minority stake in the business, you are in a much better position to attract the favorable attention of an investor, and you can share in the growth of the business. The next very important consideration is timing. Deciding on the right time to sell can have a substantial impact on the value that may be derived from disposing of your business interests. You need to be super flexible, adapting to changing circumstances within and without your business. Don't be too quick to sell. In this case, slower is faster. Rather spend a little bit more time transforming your business into an asset of value by addressing the value detractors discussed on day 1. In terms of the business itself, make sure of the following. Make sure that you present a strong investment case, supported with a set of credible financial statements. Is there a time of the year when your business looks at its best? Make sure you have efficient business systems from which you can easily and accurately extract information that investors may request, including sales and revenue data, stats related to debtors and creditors, and information about inventory, cash flow, and employees. You don't want investors to suspect that you are hiding information away. You want to be able to quickly and almost effortlessly respond to requests for information. Consider the mood within your business. It sounds crazy, but after your financial statements, the next thing prospective investors will be exposed to are your people. You want investors to find a business filled with happy and optimistic people. Plan to settle as much debt as possible by the time you present the business to investors. In terms of the wider industry, consider the following. What is happening to competitors? When last was a competitor business sold or liquidated? What are the developments amongst suppliers? Are there new suppliers entering the field, or are suppliers exiting your industry? Who are the new entrants to the sector? Is the sector growing? What about substitute products? Are there non-traditional competitors on the horizon? Then consider the wider socio-economic circumstances. Where do we find ourselves presently in the economic cycle? What is happening to interest rates? What legislative changes do you foresee that may affect your industry? What political developments may affect your business? What technological developments may affect your business and sector? Lastly, you must start promoting yourself and your business to prospective investors. People do business with people they like and trust. Long before you present your business as an investment opportunity, you must develop relationships with potential investors. You cannot wait until the day you want to sell. Investors build a pipeline of potential investment opportunities. Individual investors continually engage in buying and selling, investing and divesting. They too have a plan and think of opportunities long in advance. Savvy investors take their time to thoroughly investigate opportunities, and as part of their due diligence will want to get to know the current owner of the business. Investors typically invest in industries they are familiar with. These guys are often accomplished entrepreneurs and leaders in their field, and perhaps even in your field. It's not uncommon to find individual investors owning a stake in more than one business in the same industry. So start in your industry. Identify your competitors. Who owns these businesses? When last was a competitor business sold? Who bought that business? You may be able to find out at what price the business was sold. Approach your industry regulatory body or member organization to find out more about influential individuals. Often, major players in an industry will make sure to have representation on industry bodies. They want to have influence over what happens in the industry. Who are these people? But prospective investors may also come from other sources. Suppliers may decide to expand their operations forward, where they seek to acquire a business to distribute their product to new markets. Who owns your major suppliers? On the other hand, customers may consider buying a supplier business as a strategic acquisition. What are the prospects of a customer buying your business? Who owns these customer businesses? Other often overlooked sources of prospective buyers for your business are new entrants to your industry or businesses that offer substitute products to your customers. Build a database of prospective individual investors and then consider how will you get in contact with them? How will you get them to notice your business? How will you make a good impression? The best way to find out what investors want from a business is, well, to ask them. But that means that you must get to know them. Where do they hang out? Do they attend industry seminars? Do they publish articles on industry websites or social media? Do they run a charity with which you can get involved? In summary, first, you must identify the type of investor most likely to buy your business. Then you must decide on the mechanics of the transaction. Decide on the timing of the sale and start promoting your business to prospective investors. To access the series, visit Constructum Online Learning on YouTube or click on the link in the post.